I'm very honored to be here, to be speaking to a lot of people who are very interested in how the global economy is going to perform, as well as how to park your money for retirement and investment as well. So my topic for today really is about the global economy, but I think more importantly as well, I'm trying to find some sense of certainty, especially in this era of huge uncertainty that we have been facing throughout for the few years from now. So, but before I start, a lot of my peers and my relatives have been asking me, what is a job of an economist? So, these are some of the rumors that have been going around. What is a job of economist? Basically, what my friends think I do is just to save money. Clearly it's not. And what my parents think is that I'm doing accounting. Also no. What you guys may think is that I'm doing forecasting. I'm going to give you guys some forecast and some direction in life, and you guys can use this forecast and investments strategies to perform your retirement. Today is April Fool, so whatever forecast I give to you guys today, if it happens, it's Barnabas Gunn who told you that. But if it's not, it doesn't come to pass, April Fool. All right. What I think I do is really about presentations. Basically, I've been in the media. I've been speaking to Bloomberg writers. In fact, I'll be on TV tonight as well, Channel News Asia, speaking about commodities. So 20 to 30% of the time, I do speak to public like this. But a good 70 to 80% of the time, I'll be putting my head in my hands sometimes in the office. Not because I hate my job, but also because of the fact that there are so much uncertainties. The economists, we like to say on one hand and on the other hand, and there's so much uncertainties, and sometimes we just have to find a direction, to give to the investor, to give to the senior management on what we guys have to find out, what we guys know about 3 months, 6 months, 9 months down the road. So my agenda for today basically is hopefully I can give you guys a good presentation, but also more importantly as well is to tell you guys where the risks and opportunities lies in the next arena. I will teach you guys how to so-called save money through whatever investment tools that I am going to present as well, and to really use my crystal ball. I left my crystal ball at home, but if there is any forecast that you guys have any questions to ask me later during the Q&A, I'll be very happy to talk about them. All right. So my presentation is divided into 4 key themes, all right? And I love to present through pictures. So at every start of the theme, in fact, there's a webcast as well at the end of the presentation. If you guys look through it again, the pictures that I have presented basically summarizes the points that I am trying to portray to everyone. So tomorrow will always be better, 明天会更好, and without starting, I'll just say Happy New Year. I know it's April, but hope everybody is having a good year. There's still 9 months into 2017, and this year is basically a red fire chicken year. Not spicy chicken, not KFC, red fire chicken year. Okay, so 明天会更好. Basically, what we are trying to tell you guys is that the World Bank, as well as a lot of other global investors, as an economist, you always talk about GDP. The first thing that we learn in school is GDP. So I have to talk about GDP so that it makes me feel like an economist, So, but really, growth and GDP, it's something that we look at very closely to gauge how growth and how healthy the global economy is. So basically, what the World Bank is saying is that in the year 2017, which is this year, global growth should pick up from 2.3% to 2.7%. But more importantly as well, it's one thing to tell you guys growth is going to be better. It's another thing to tell you guys which regions are actually doing well. So if you just look at the regions per se, it is heartening to see that both developed countries and both developing economies are expected to accelerate. This is something that's not seen for a good like a good 3-4 years down the road. This is the first year that the World Bank and the IMF actually looking at a pickup in growth in both of the specific regions. Just look at the various countries. The United States, the World Bank is looking at growth to pick up from 1.6% to 2.2%. And last year was a very bad year. In fact, everyone can agree with me that 2016 was a challenging year for the global economies, for businesses in general. If you guys own businesses in Singapore, if you just look at the oil and gas space in Singapore back in 2016, it was a challenging environment. So whatever that goes down, should come up, and this is the basic message that we are actually trying to portray. And sitting in Asia, basically, there are two things that we have to talk about. We have to concentrate on when we talk about Asian economies. And Asia, we have two key indicators that we look at very closely. First is trade and investment. And simply because Asia is primarily an export-oriented economy. Basically, we export for a living. We produce in Singapore, we produce our manufacturing, our semiconductors, our pharmaceutical products, and we don't consume it 100% in Singapore. We export a lot of it out to our various trading partners. So the health of the Singapore economy, or the health of the Asian economy in particular, follows somewhat this same model when it comes to global health, when it comes to growth and purchasing power for the Asian economies. So how is growth actually performing in Asia as a whole? This is the trade. The trade in Asia, basically, back in the 2008-2009 financial crisis, we have actually seen that growth actually fell by more than 30% during the Lehman crisis when Lehman Brothers actually was liquidated and was forced out of the financial markets. But really, sadly, there was also another dip again back in 2015, 2016, and this is also really because of the falling oil prices. But the consolation is this. The consolation is that it has been picking up. It's pointing north right now. If you look at the export growth in Asia, it is back in positive territories. And if the trend continues, it does mean that growth in Asia and growth in Singapore is going to be better into 2017 itself. So again, regions. If you just look at the two charts on this slide, basically on the right-hand side of the chart is how growth actually performed in 2016. And it's a very bleak environment back then. We have seen most of the Asian economies like Hong Kong, India, Taiwan, those key manufacturing hubs, they have been performing very lackluster during the 2016 era. But the thing is that the good message is that in 2017, a lot of the Asian economies, has performed marvelously, since the start of the year. And for manufacturing, the PMI, these are PMI charts. I know it's a little bit messy, but all you guys have to look at is anything that's above 50 and anything that's below 50. The 50 mark is so-called the benchmark when it comes to how positive or how negative the graph is. So if the line is above 50, it means that the manufacturing sector is optimistic about the environment. If it's below 50, it means that the manufacturing sector is actually not so optimistic about the environment. So as you can see across key economies, not only in Asia, but in the developed markets like the US, like the EU, UK, Japan, it has been all above 50. And that's a good sign. But for Asia, I think the only worrying country is Korea, and that is actually is understandable simply because of the political issues that has been ongoing in Asia, at this time. And Singapore, as mentioning, the manufacturing sector has been doing well, 11.5%, very good, since the 4Q 2016. And if you just see the industrial production, if you just see the export growth, Singapore is doing well, at least from the key fundamentals, key indicators point of view. The improving electronic space and the improving pharmaceutical space that we have seen is actually a good sign that the Singapore economy is actually doing well into 2017 itself. So last year we are printing about 2.0% growth. This year we are actually looking at about 2.5% for 2017. Excuse me. All right. My next theme is about inflation. I think this is a natural behavior when it comes to how the global economy is going to perform. Simply because of the fact that when there is higher growth, the previous theme that I talked about is higher growth. When there's higher growth, it means that there is better purchasing power. And people have more wealth, people have better jobs, unemployment falls. And because of this, when demand starts to pick up in the global economy, it does also mean that prices, not only in Singapore but across the globe, may actually pick up as well. And this is something that we should actually pay attention to when it comes to higher prices. Oil is one of them. In the last budget, when we heard water prices have been increased by 30%, but more importantly is the bak chor mee. Simply because I am very bitter about bak chor mee. The only bak chor mee store in Raffles Place just across my office, which is $5, bak chor mee has closed down. I will be willing to pay $6 for a bak chor mee, but I can't find any more bak chor mee around. Downstairs my place is only $2.50. At my office it's $5. But the point is this: inflation is picking up. Bak chor mee prices is picking up. I may have to worry about my kopi siew dai if I don't plan for retirement. So it's a good thing that you guys are here to plan for retirement, so that you guys can have kopi siew dai in the next 10, 15 years down the road. So food and oil prices are picking up. So that is a fact. In statistics, if you just look at the graph, it's all picking up. We have seen higher oil prices. We have seen higher food prices across the last years or so. Bak kwa. The famous bak kwa index, this is a scary chart. It does not care about crisis. It does not care about the Lehman Brothers crisis. It does not care about global growth. It's just one way. For the last 10 years, back in 2007, bak kwa was $37. Was $37. 10 years down, as of last Chinese New Year, it's actually $57 per kg. It's almost twice the price. And 10 years down the road, if such a trend picks up and continues, that will actually mean that bak kwa in the next 10 years, 2027, will be $100 per kg. Don't need to eat bak kwa already. But going for but if you just look at crude oil as well, when you talk about commodities, it's always about fundamentals. Higher supply, low demand, prices fall. But if demand picks up due to global growth, and especially crude oil is a raw material for gasoline and driving cars and stuff like that. Improvement in global growth should mean that people buy bigger cars. Should mean that people drive more cars, basically. And because of this, the demand should actually pick up. And that's why oil prices into the next 6 to 9, 12 months down the road, it's likely to be on an upscale. And why do I talk about food and energy prices when I talk about inflation? It's because of this very key aspect that in the inflation basket, when economists look at the inflation basket, we actually look at a basket of products, so to speak. So in the Singapore case, we actually look at housing and utilities, food, transport, so on and so forth. Even your Singtel phone bill also goes inside. But the thing is this: energy and food have the biggest component when it comes to the inflation basket. And it's the same for almost all economies in the world. Food and crude oil, food and energy prices makes up a bulk of how price levels actually perform in a economy. So the point is this: there is higher oil prices, there's higher food prices, but there's also higher water prices that has been injected in since the last budget, 30% over the last two phases. But I just want to preach a message of comfort here, simply because there are rebates, and we know there are use-save rebates. There is a GST voucher. There is a cut in income tax as well. So the point is that even though water prices go up, that doesn't mean that the inflation will go up by 30%. Prices rise by 30% for the water doesn't mean that inflation will rise by 30%. It's not. Even though prices rise by 30%, the component for the inflation basket in Singapore is only about 3%. So that means that the impact of water prices into our domestic inflation in Singapore is very small. That is the message. So as I've mentioned, there are rebates, there are incentives from the government to actually try to defray the higher water costs. In fact, for those households that is staying in 1 to 2 rooms flats in HDB, they practically don't see any increase at all, simply because of the rebates that has been pushed out. So, as mentioned, Singapore's inflation for 2017, although water prices have risen by 30%, if you guys heard the news, in fact, the electricity bill in Singapore is going to rise for the next 3 months. But beyond that, I think the overall inflation environment in Singapore is very comforting. Why do I say this? Because inflation is only expected to rise only 1% in the coming year, in this year. If you contrast this with the other economies across the world, let's not talk about Japan. Japan is on a deflationary mode for the last 10, 20 years, ago. But the point is that across the other developed markets, you see the US, you see China, New Zealand, UK, the inflation as being about 2%. It's still good, but at least in Singapore, sitting right here, if I'm talking about inflation at 1%, it's still quite manageable. But hopefully in the next 10 years' time, we don't see $100 bakwa. Okay, the third theme that I want to talk about is tightening rates. This is also a influence from higher growth. Why is that so? Because of higher growth, prices will increase, but inflation and interest rates should also increase in tandem. This is actually a monetary prudency tool that the central bank across the world actually uses to try to curb inflation. But the point is that when there's higher growth, inflation goes up, but interest rates should normally go up as well. This is a natural course of things when it comes to economics. So the two pictures that I chose today is with higher interest rates in Singapore. If we are going to see higher interest rates, for those of us right here who are homeowners and have housing loans, we all know that our housing loan is pegged to the SIBOR and the SOR, which is the basic the interest rate benchmark that banks actually use to charge our housing loan. So if interest rate goes up, it does mean that the burden, the debt burden for average household may go up in tandem. But the thing is that even though with higher debt burden, higher interest rates should also mean better opportunity in the investment world, and I actually have this graph right here. Basically, a good part of this particular investment tool that is readily found in Singapore. Out of 100%, 44% of people who are aged 48 years old and above actually bought this. So hold on to your seats. I will just show you guys later what investment tool I'm talking about when it comes to this. So many people buy this, more than 44% age 48 years old. It must be something. So going back to interest rates, the U.S. Central Bank, which is the Federal Reserve, basically has injected higher interest rates, has actually pushed up the interest rates in the last central bank meeting in March. So the issue is that if we just look at this chart, it's actually a dot plot chart. This is a chart that we look at very closely, that economists look at very closely. How do you read this chart? Basically, if I could just use my laser pointer right here, if you just see the dot, one dot right here, basically, one dot represents one particular central bank member that has indicated his or her outlook for interest rates to be in the year 2017. So basically this dot right here that I just point means that one person in the central bank is actually expecting the FOMC rate or the central bank rate to actually be at around 2 to 2.25%. So this is just one dot. So in order to see how much interest rates may be injected into the US economy, we just look at how the dots cluster around each other. If there is a lot of dots that cluster around a certain point, it means that a lot of the central bank committee members are expecting rates to be at such a level. So that's why I draw this line right here. It's clustering around this few dots right here. So that means that the interest rates in the US are expected to go up, into the year 2019, into the longer term. So, and so what does this mean for the Singapore economy? So what if the US interest rates go up? And how does that affect a Singaporean, so to speak, sitting in Singapore? During the growth years from 2000 to 2005, when interest rates go up in the US, just let's say Hong Kong, this is a correlation. Correlation means that at every 1% of increase in the US rates, for Hong Kong, it actually increases by almost the same proportion, almost the same level. But for Singapore, it's about 0.9. That means that if the US rates actually rise by 1%, the Singapore interest rates generally actually rises by 0.9%. So that means that there is a positive correlation or a positive direction when it comes to higher interest rates in the US, higher Singapore rates as well domestically. So as mentioned, the higher interest rates in the US should actually inject eventually higher interest rates in Singapore. In fact, our SIBOR and SOR rates basically have the US LIBOR, the US 3-month interbank rates in the calculation as well. So as such, when higher interest rates are seen in the US, basically we can well expect that the Singapore interest rates actually go up in tandem. So, how like that? Higher interest rates, debt burden in the household may actually increase because of housing loans and stuff like that. So, there are bad debts that have been increasingly be written off, over the last few years or so. And if you just look at the right-hand side chart, basically it shows the quality of assets for an average household. It's a asset to liabilities ratio. Basically, when the line goes down, it means that the value of assets has fallen while the value of liabilities increase. Hence the line go down. So if you just see the line, basically it has fallen for quite some time already before picking up slightly at end 2016. But the point is that the asset quality in Singapore has not been where it was before the Asian financial crisis back in 1996. But not to worry, the answer to my question just now on the investment tool basically is the Singapore savings bonds. 48 people who are more than 48 years old actually constitute about 44% of the purchase in the Singapore savings bonds. Why is that so? Because with higher interest rates in Singapore, it's also a function for higher bond yields as well, across the domestic economy. So with higher interest rates, higher bond yields, it also means that the returns for whatever investment tool that you guys have, if the interest rate goes up in tandem, it means that there is actually better returns from your investment. And the Singapore savings bonds is one of them. With higher interest rates, with higher bond yields, it may mean that there'll be better returns as well when it comes to your investments. Right. My last point, it's about risk. I've been saying a lot of good news so far, and if I just end this presentation with just good news and everybody feel very rosy and happy, I have not done you guys a service. I want to tell you guys that it's a good environment. Everything is doing well. The manufacturing sector is doing okay. Exports is doing okay. There is only very mild inflation, and stuff like that. But I just want to preach a message of cautiousness as well, because there are some things that's going around in the global space that we should pay very close attention, especially we are sitting in Singapore. We are talking about the European economy. We're also talking about the US and China as well. So, the European economy is going through some issues. If those who have been paying close attention to the European exit issues, basically Geert Wilders, who is the politician in Netherlands, that has been calling for the exit from Netherlands from the Eurozone. Basically, he has been voted out, and that's actually good news for the global economy, because if Netherlands get voted out, it means that not only Britain has left the Eurozone, but also because of the fact that Geert Wilders will also have left. The Netherlands will also have left. But the thing is that there is still impending risk in these issues simply because of Germany and France. France election is coming already next month in April. This month. Today's April Fool. This month. But the thing is that for Germany is in the second half of this year, and the elections may actually give rise again to European exit fears. And this actually basically tries to pressure down risk appetite, pressure down volatility and volume in purchasing of equities and risk-related assets, so to speak. And that could actually be bad for how investment returns can actually perform in Singapore. So what are the polls saying? It's not so worrying right now. It has fallen a little bit, but however, the French election poll, Marine Le Pen, who is gunning for a France exit, or what we call a Frexit, she calls herself Madame Frexit. So the name says so much about her. She's almost winning. She's already the first runner-up when it comes to the polling results. But Petrie, who is the politician who is gunning for the Germany's exit. It's still about third. So that's still a little bit not so worrying. But when the events actually take place, when we approach the election dates, do expect that there could be some fall in risk appetite during that period of time. So this is a chart, a poll across all the Eurozone countries. Very interesting to see that Poland wants to be in the Eurozone, but I think we should pay attention to those countries who don't want to be in the Eurozone. Greece is one of them. France is one of them. The UK have left, and Spain and Germany is a bit shaky when it comes to if they are going to join or leave, the Eurozone. So there's something that we have to watch out for as well. The Eurozone political concerns. So this is the European flag. Basically one star represents one country, and the UK has already left. So one star, they have to change the flag sooner or later. Over the next 2 years, they have to change the flag. So maybe it's only one star who has left. But will the flag stay like this, or will the flag become this? So it's a worrying. It's somewhat worrying if the flag turns out this, and then the entire future of the Eurozone, the entire future of how the Euro is going to perform, it will be in question, but the risk is there. So my job is to point you, to tell you guys that there is a concern like that. Trump, I can't end my presentation properly without talking about President Trump. I think the point, I try to be factual, alright guys, I try to be factual. The Mexican War is not built. And also for the fact that none of his economic policies that he has promised during his campaign has actually taken shape. None of it has actually happened. He talked about banning the immigrants to come in, and the courts actually ruled him out. He talked about labeling China as a currency manipulator, but nothing is happening as well on that front. So what is he trying to do? So hence there's this word called the Trump uncertainty. Whatever he's going to say is going to move the markets. Whatever that he doesn't say also move the markets. So this is a uncertainty right there. This is the bell curve basically. So the most probable scenario is that Trump is going to bring embarrassment to America on a global scale, and this arguably has been seen so far. Simply because he tried to push forward his American healthcare plan, or what we call the AHCA, but it's also dead in the waters. Nothing has happened. So what is he? What other policy? What other ammo does he have to actually try to push out economic policies in the future? No one knows. And the Trump risk has been heavily emphasized as well, even before he became president. The issue is this: in a recent study by the Economist Intelligence Unit during the campaigning period, or the EIU, they actually said that the risk of Trump winning the U.S. election basically is of the same risk that there is a terrorism that destabilizes the global economy. So this is the Trump risk that's been heavily emphasized even before he became president. So there is some concerns right there, as we speak. So the trade war is something that we are very concerned about, simply because he has been threatening to ban exports. He's trying to ban imports. Ban imports, and he's trying to say that he wants to label China as a currency manipulator, and to slap a certain percentage point of tariff against Chinese products and across all other U.S. products, bring the companies back into America, hire American, buy American. Nothing is being said so far. But this is the worst case scenario. If there is a trade war, if there is a tariff against the imports that are coming into the U.S., we should look at the trade exposures, from China and the U.S. So if China suffers, the entire Asia suffers. If the U.S. bans exports against all other Asian economies, there is a double whammy for Asia as well. So not only China per se, but across Asia as a region may actually suffer if the trade war actually happens. So we should look at the trade exposures as well. The key countries that is of most concern really is Hong Kong, Taiwan, Korea, and Japan. As you can see, the highest trade exposures. That's something that actually to take note. But the tables have turned. Consolation prize, the U.S. is trying to gun for protectionism and to protect the American industries. But China is different right now. The tables have turned. Sorry, too excited. The tables have turned. The tables have turned. Basically, America was a symbol of free trade. And China, before they joined the WTO many, many years ago, they were living in the era of protectionism. The roles have switched. Xi Jinping, in the last speech that he had in the World Economic Forum, said it very, very starkly. He said that pursuing protectionism is just like locking oneself in a dark room, so and so forth. But I want to say in Chinese, to bring out the flavor, all right? What he actually said in the World Economic Forum basically is, 搞保护主义如同把自己关进黑屋子，看似躲过了风吹雨打，但也隔绝了阳光和空气。打贸易战的结果只能是两败俱伤。Basically, it means that when there is protectionism, there is no winner. Both will lose. So why fight the war of protectionism? So this is a consolation prize if both countries, once protectionism are finished. But then China is basically trying to gun for free trade. So there's something of consolation. So let me sum up. I'm at the end of my presentation already. Basically, what I'm saying is that good news. 2017 is a good message this year. Most likely, there will be better risk appetite. Global growth is improving, and your risk appetite should actually improve into the years down the road. But there are two drivers, there are two influences when it comes to higher growth. One is higher inflation. Second is higher interest rates. This is something that you have to look at very closely on that. Last but not least is about prudency. There are risks in the global economy no matter what. Global growth is picking up, sure, but there are still pockets of risk that we have to pay very close attention to when it comes to the global growth. We talk about the European crisis, we talk about the US economy, we have to talk about protectionism as well. So we have to pay close attention to that. All right, thank you very much. I hope that I have made sense. Sometimes economists, we try to be ahead of ourselves and we try to speak, and I hope that there is something that you guys can take forward to. I present my favorite cartoon to you guys, and whatever questions that you guys have, basically for the Q&A, I'll be more than happy to answer. Thanks, guys.